In this video, I'm going to show the top 5 Bollinger Band secrets that I learned after many years of studying the financial markets. Like I said in the video about moving average secrets, you'll find many people who will charge you for this level of information, but I believe this to be basic enough to be given away for free. If you haven't watched the video about moving average secrets, I encourage you to do so because Bollinger Bands are an indicator that builds on top of moving averages. So it's a good idea to have a good grasp on the fundamental properties of moving averages first. With that said, let's move on to the first Bollinger Band secret. Secret number 1. The meaning of Bollinger Bands. Many traders have the habit of plotting indicators and lines on a chart without really understanding the origin of such lines and their meaning. That's certainly the case with Bollinger Bands. The Bollinger Bands indicator is composed of 3 lines. The center line is a moving average, and the 2 outer lines are moving standard deviations of price. In finance, standard deviation is a measure of volatility. In other words, the Bollinger Bands indicator attempts to model the volatility of price given a certain number of past periods. With that said, we have to understand the meaning of standard deviation since it's the core component of the Bollinger Bands indicator. As the name suggests, the standard deviation measures how much the data points stretch away from the mean of data points. In this illustration, we have 2 examples that indicate the standard deviation. When data points don't stretch too much away from the mean, we have low standard deviation. When the data points do stretch away more abruptly, we have higher standard deviation. Just for curiosity, below we have the formula for the standard deviation, but we are not going into detail on that in this video since we are only interested in the rough intuition about standard deviation for now. By looking at these 2 situations, we can sort of understand why the Bollinger Bands is a volatility indicator. When price is calm and not deviating too much from its mean, the Bollinger Bands will be narrow. When price is volatile and showing a lot of powerful movements, the Bollinger Bands will expand. The bottom line about standard deviation in the paradigm of Bollinger Bands is that narrow bands mean low volatility and wide bands mean high volatility. One paramount detail here that you must never forget is that since Bollinger Bands are built on moving averages and moving standard deviations, they have lag. That means that if the Bollinger Bands are displaying high volatility at the moment with wide bands, that might not necessarily reflect the current moment since it's an average of past periods. This is the old problem of lag we talked about in the video about moving averages. In this chart, we can see a good example of how narrow and wide bands reflect the market volatility. On the left, the narrow bands reflected a rather calm market. After a while, price exploded to the upside, and that made the Bollinger Bands expand also. Notice that there is some lag in the way they expand since Bollinger Bands are built using moving averages and moving standard deviations. Secret number 2. The empirical rule in statistics. The next secret I want to show you is related to something called the empirical rule in statistics. You probably already noticed that the standard setting for Bollinger Bands is 2 standard deviations from the mean. That's actually one of the very few places in technical analysis where numbers are not randomly or arbitrarily chosen. In this case, the motivation for using 2 standard deviations from the mean is the empirical rule in statistics. The empirical rule states that, assuming we are talking about normally distributed data, 68% of the data will fall within 1 standard deviation from the mean, 95% of the data will fall within 2 standard deviations from the mean, and 99.7% of the data will fall within 3 standard deviations from the mean. The fact that Bollinger Bands have a default setting of 2 standard deviations from the mean is because the indicator was built to show movements where price stretches too much away from the mean with a certain degree of frequency. It's much easier to understand what all of that means by using a chart example. In this first chart, I plotted a Bollinger Bands indicator, but I altered the number of standard deviations to 1. According to the empirical rule, when we use 1 standard deviation from the mean, only 68% of price will fall within the Bollinger Bands. Just by looking at the chart, we can more or less observe that this makes sense. Roughly 68% of price is captured inside the Bollinger Bands. In the second chart, I altered the number of standard deviations to 2. This is the default setting of the Bollinger Bands indicator, and according to the empirical rule, 95% of price falls within the Bollinger Bands. We can see that this is more or less correct because most of price action is captured inside the Bollinger Bands. There are only a few places where price goes out the limits provided by the two moving standard deviations. In the third chart, I altered the number of standard deviations to 3. Notice that now there are even less places where price goes outside the boundaries established by the moving standard deviations. This of course agrees with the empirical rule, which states that 99.7% of data will fall within the 3 standard deviations from the mean. The use of this is pretty intuitive. When price goes outside the boundaries provided by the moving standard deviations, it means that it's too stretched away and it will tend to reverse. The additional detail that not all traders know is that it's one thing when price goes out the 2 standard deviation barrier, and it's another when price goes out the 3 standard deviations barrier. According to the empirical rule, price going out 3 standard deviations from the mean is a much stronger and rarer event. You tend to notice that most of the times that price goes out the 3 standard deviations barrier, it will reverse at least a little bit. When 2 standard deviations are used, you observe that price will continue going outside the boundaries in many cases. This leads us directly to the third secret about Bollinger Bands. Secret number 3, the reversibility property. What we learned in the second secret about Bollinger Bands regarding the empirical rule in statistics gives rise to the third secret we're going to talk about, which is the behavior of price in relation to the moving standard deviations. We already talked about the rough intuition of what standard deviation means. The reversibility of price is how likely price is to reverse at a certain point in the chart. For example, when price surpasses the upper or lower Bollinger Band, it has a chance of reversing back to the mean because it is too stretched away from the mean. Like we observed in secret number 2, the higher the number of standard deviations, the less likely it is that price goes outside the Bollinger Bands. In the particular case of the Bollinger Bands, there are optimal numbers for the standard deviation. If the trader uses 2 standard deviations from the mean, price will often go outside the boundaries. If the trader uses 3 standard deviations from the mean, the number of times that price go out of the Bollinger Bands will be reduced. However, when price does go out the Bollinger Bands, it will have a bigger chance of reversing at that point. In this chart, we can see an example of this reversibility property I'm talking about. I plotted 2 Bollinger Bands on top of each other. One of them has 2 standard deviations from the mean, and the other has 3 standard deviations from the mean. The orange channels show the space in between the second and third standard deviations. In the first arrow marked in the chart, we can see that price goes outside the boundaries represented by the Bollinger Bands with 2 standard deviations from the mean. Notice that price doesn't reverse immediately. In the second red arrow, we see price going outside the boundaries established by the Bollinger Bands with 3 standard deviations from the mean. Once price closes beyond that level, it immediately reverses back to the mean. It's important that you understand that this doesn't always happen. On the right side of the chart, we can see another example. Price does break out the 2 standard deviations barrier, but it's not until it breaks the 3 standard deviation barrier that it starts to reverse back to the mean as it is shown by the green arrow. The takeaway from this third secret about Bollinger Bands is that the higher the number of standard deviations price breaks out of, the more likely it is that it will reverse back to the mean. Even though that makes sense statistically speaking, there are more pernicious problems that get in the way of this property of price. One of these detrimental problems is related to the fact that price charts are non-stationary, which is the subject of the next secret about Bollinger Bands. Secret number 4. The problem of mean reversion in non-stationary time series. The first strategy that comes to mind when we think about Bollinger Bands is assuming that price will reverse direction when it surpasses one of the outer bands and will reverse back to the center moving average. As we saw in the third secret, the bigger the number of standard deviations price stretches away from the mean, the more likely it is that it will immediately reverse back to the mean. This is known as a mean-reverting strategy. However, there is a fundamental problem when we try to apply this strategy in price charts. Price charts have the property of being non-stationary, which means that they have variable mean and variable standard deviation. Another way of looking at this is that price charts have trends that change continuously. By definition, mean-reverting strategies only work well on time series that are stationary, meaning those who have constant mean and constant standard deviation. A stationary time series looks like a sideways market, and any mean-reverting strategy only works in such a scenario because the series continues to be stationary. In any price chart, the market alternates between sideways movement and trending movement in a rather unpredictable way, so using a mean-reverting strategy is a bad idea. In this chart, we can see that price was in stationary mode inside the green box, meaning that it was a sideways market. Notice how the mean-reverting strategy will work perfectly well in this case because we have a flat mean and a flat standard deviation. In the second chart, we can spot the problem of mean-reverting strategies in non-stationary markets. In the first green box, we can see that price escapes the boundaries outlined by the Bollinger Bands, so the trader could think it would be a good idea to buy the market with the hope that it reverses back to the mean. Here's the critical point about this. Price will always reverse back to the mean, but the problem is that in non-stationary or trending markets, the mean will also move. So by the time price reaches the mean again, it will be in a different position and a loss will occur. In the second green box, we can see that price indeed reversed back to the mean, but since it takes time for price to do that, and the mean was going down due to the fact that the market was trending down, by the time price reached the mean, it would generate a loss instead of a profit. Very much like the problem of finding the optimal moving average periods for a crossover strategy, the trader can never truly know when the market will shift between sideways and trending modes. To make a simple analogy, trading a mean-reverting strategy in a non-stationary price chart is like trying to score a goal with moving goalposts. By the time the ball reaches the goalpost will be in a different position and you'll miss the goal completely. Secret number 5. Bollinger Bands as dynamic support and resistance. Another use of the Bollinger Bands is as dynamic support and resistance, very much like in the way that was demonstrated in the videos about moving average secrets. The outer lines and the center line of the Bollinger Bands indicator can all act as dynamic support and resistance. This already opens up several possibilities because there are 3 powerful settings that can be used and that agree with the empirical rule we talked about previously. The settings are, of course, 1, 2, and 3 standard deviations. One important detail is the angle of the moving standard deviations. When the moving standard deviations are going against price, they tend to provide stronger barriers. When they are going in the same direction as price, they tend to represent weaker barriers. The flat angle in the moving standard deviation works in a less intuitive way, because a flat angle will usually mean a sideways market, so the barrier will be strong even though the angle isn't steep. All of these details regarding the moving standard deviation angle are just guidelines, of course. It doesn't always work that way. In this chart, we can see how the moving standard deviations can work as barriers for price as it is highlighted in the red circles. An additional trick we can use in certain situations is visualizing the Bollinger Bands from other timeframes to see if there are any barriers for price. In this chart, I plotted 2 Bollinger Bands. The red one is from the native 1-hour chart, and the black one is from the 4-hour chart. In the green boxes, we can see movements where price was interacting with the moving standard deviations from both the 1-hour chart and the 4-hour chart. That will be additional strength to the idea of treating Bollinger Bands as dynamic support and resistance lines. However, before you attempt to transform this into a strategy, keep in mind that it's not so simple as observing where the lines correlate. There are many more aspects you would need to consider in order to transform this into a strategy, but this is a subject for another video. I hope you learned something new and useful with this video. If you want to learn how to trade with professional techniques, please check out the video courses I provide. For beginner to intermediate traders, I offer the Fractal Flow series, which is composed by the Fractal Flow strategy, the Market Maker strategy, and the Newtonian trading strategy. Each one of these will teach you a different approach to trading. Each of these strategies work on their own, but they can be combined together also. They work on any market and in any time frame that you wish to trade. For intermediate to advanced traders, I offer the Price Action series, which is composed by heavyweight techniques involving fractal geometry, linear algebra, a very refined contextual market reading to find the most accurate trade entries and exits that are possible to find on a price chart. You can visit my website fractalflowpro.com to see more details about the table of contents of each course and the testimonials from students. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.